I used to run a trading desk on Wall Street for 13 years. I started out at Goldman Sachs in fixed income derivatives and ended up running my own desk at Deutsche Bank. An interesting thing happened while I was on the street. I had a friend doing a PhD in neuroscience at Rockefeller, which is on the Upper East Side of Manhattan. And I used to play hooky from the trading desk when things were slow and go up and help with experiments. And at the time, what I was doing down on Wall Street and what I was learning about neuroscience at Rockefeller were just two completely independent streams in my life. But eventually it came to occur to me that while down on Wall Street, we were asking, why do traders go rogue? What is irrational exuberance? Unbeknownst to the street, uptown at Rockefeller, they were actually working on the answer. They just didn't know about it. And I became so convinced that the physiological sciences, neuroscience, could help us understand the pathologies and risk-taking we find in the financial world, that I made the insane decision of quitting high-paying job on Wall Street and taking up the minimum wage job of science back at Cambridge, where I've been running experiments studying the biology of traders here in the city ever since. And I've been working on one thing in particular. I suppose it's the same thing I've been working on while I was a trader and now while I'm a scientist. And that is, I'm trying to understand the cycles of risk-taking that we all live with in the financial markets, where we go through periods of good times where we take excessive risks, and in bad times we freeze up in risk aversion. This massive shifts in risk appetite across the cycle are probably the single most important destabilizing influence on the financial markets, and probably the largest standing challenge for financial institutions. What on earth is driving these risk-taking pathologies? And it's not just in financial firms. I know traders on a winning streak tend to become masters of the universe. They take increasing amounts of risk with decreasing risk-reward payoffs, and they eventually blow up. Every time we see a trader that's lost north of $1 billion and shaken its bank to the foundation, it's a trader that's at the tail end of a 2 or 3 year winning streak. So something happens to traders when they get on a winning streak. But it's not just traders. I mean, we're getting a lot of calls from people outside the financial sector, non-financial firms, who are going through the same cycles. When things are going well, maybe they do too many M&As. Maybe they're too aggressive on tax breaks. Maybe they're opening up too many offices. Maybe they're drilling too deep. As a result, they blow up. And then the entire firm freezes up in risk aversion. And the trouble with that is it's as dangerous as the excess of risk-taking that leads to the blow-up. Because generally when these firms freeze up in risk aversion, it's exactly at the point when the market offers the most attractive opportunities. So these pro-cyclical shifts in risk preferences are really the major challenge, I think, for the financial world. And it's showing up right now. I mean, the banks well, all financial firms are so keen on preventing rogue traders, any more trading disasters, any more trading injuries, that they've got these massive search engines that go through terabytes of data. They go through the trading data, they go through the VAR, risk behavior, text messages, email messages, swipe cards. They've got these massive databases, and they've got these search engines that go through looking for deviations. They get to know each one of the individual traders and employees, and they're looking for deviations from the normal pattern. The trouble is, and this is a very common model that's now being used in digital health. The difference between digital health and digital risk management, if you will, is that underlying digital health is a very mature science, medical science. But underlying digital risk management, there's a very undeveloped science. And as a result, these big search engines are turning up a distracting number of false positives. And risk management is spending a hell of a lot of time tracking down this large number of false positives. What they really need is the science underlying risk-taking that will allow them to understand why it is that traders go rogue, why it is that traders freeze up in risk aversion, so that their risk management searches can become much more intelligent and stop throwing up so many false positives. In some sense, that's what we're working on. And I think since returning to Cambridge, I have to tell you the single most important thing I've learned, and that is we're not going to understand those risk-taking pathologies if we continue to believe the model that we're all taught in economics and finance. And the essence of that model, I'm not going to start talking about rational versus irrational. I'm not going to talk about rational versus emotions. I don't think those are the issues. I think those are red herrings. What I am talking about is the following, that in underlying all the models you study in economics and finance is the belief that what you are doing in financial risk-taking, in fact, what you're doing in any office job, is a purely cognitive activity. In other words, it's the activity of pure mind. And underlying this is this very fundamental notion in the West that we're capable of pure thought, that there is this separation between mind and body. But there isn't a shred of scientific evidence to back up anything like that vision of a human being. Our body and our brain are intimately connected. The reason we have a larger brain is because it's to control a more sophisticated set of muscles. We grew a larger brain to control a more sophisticated set of muscles. The point of your brain is not to sustain pure thought. It's to plan and execute movement. If you can take one thing away from this talk, it's that one statement. Your brain is designed to plan and execute movement. And that means every thought you think, every piece of information you take in, your brain silently behind the scenes is figuring out what movement might ensue from this. For us, there is no such thing as pure information. For us, information is always a physical event. Every thought you think comes coupled with some physical change. We may live in the digital age, but for humans, it remains a very physical age. And understanding the physical changes that we go through when we take risk is the key to understanding the pathologies in risk-taking. Because one of the ways we manage our metabolism, we have metabolic reserves, just like a bank account, and we have to manage them. And we use those metabolic reserves to prepare us for impending movement. And if there's no impending movement, we don't waste our metabolic reserves. But when we're expecting a lot of movement, we draw out our reserves so that they're ready for us. And the way that shows up is through shifting risk preferences. When opportunities abound, it's like one of the ways we release our metabolic reserves to take advantage of these opportunities, that shows up through excessive risk-taking or expanded risk-taking. In times of stress, when we don't understand the world, we're in a period of prolonged uncertainty, we scale back. Risk preferences are shifting, even though one of the most fundamental assumptions in economics and finance is that your risk preferences are a stable trait. You're born with them, and at adulthood, they're stable, just like your height. But they're not. They shift dramatically, depending on your circumstances. Now, when we started publishing our results, the first thing we looked at was how why it is that traders go rogue when they're on a winning streak. And we found that, in fact, anabolic hormones were playing an important part of it. Because anabolic hormones, as you know from sports, are hormones that we draw on when we enter into a risk-taking or a competitive situation. And it turned out that these were shifting risk preferences towards the more risk-taking. The results were extremely powerful. They were published in the Proceedings of the National Academy of Sciences a few years ago. And I'm not going to go into those details, but I am going to say that when we published them, I was contacted by a group of very elite sports physiologists who said, you know, it's interesting what you're discovering about risk-taking and anabolic hormones because your very good traders have the same physiological signature as our best athletes. And I thought, well, that's pretty weird. Why would that be? But the more I thought about it, the more it made sense. It's not like we have one biology that we use in sports, one that we use in war, one that we use in the courtroom, and one we use in the financial markets. We only have one biology. We take it wherever we go. So it's not surprising that there's similarities between these worlds. And that led us on to look at the possibility of managing traders just as you manage an athlete. Now, is that possible? Can we improve? Can we build a better trader? And what we found is that, because in economics, there's the belief that you can't outperform the broad market. The market is random, it's efficient, you can't outperform it. No property of your makeup will help you outperform the market. Not your intelligence, not your training, any more than it can help you flip coins. But in one of the studies when we found that the anabolic hormones in the traders' bodies were predicting their P&L, we asked, well, how's it having that effect? Is it affecting the amount of risk they take or their Sharpe ratios? In other words, their skill. Now, Sharpe ratios, for anybody who's not aware of it, are the profit you're making divided by the amount of risk you took to make that profit. So it's return over the variance of the return. So it's how much profit you're making per unit of risk. And in this study with 54 traders over a 2-year period, we found something that was sort of striking. It has nothing really to do with physiology, but it shows you when you really mix with the data how it sort of destroys pet theories, like the fact that you can't outperform the broad market. The broad market during this study was the European stock markets, the DAX or the stocks, which has a long-term Sharpe of about 5. The beginning traders had a Sharpe, as you might expect, of about 0. But at 2 years of trading, they were already matching the broad market. And the longer they traded, the higher their Sharpe ratio went. Now, there's two things wrong with that. One, according to classic economic theory, you can't outperform the broad market. You can't have a Sharpe ratio higher than the broad market. These traders did. What's more, the longer they were trading, the higher their Sharpe ratios were becoming. They were learning. And you can't learn if the market is purely rational or purely random, just as you can't learn from flipping a coin. So these traders were not only learning, they were outperforming the broad market. And that was really interesting. And it shows that, in fact, what it turned out is that we found that a bunch of biomarkers in these traders were predicting their P&L. But the risk management and the comp schemes at this hedge fund were causing these traders to want to maximize their Sharpe ratios, their prudence, rather than, say, the variance of their P&L or just the pure size of it. Because someone who makes $100 million looks like a star, but if they could have just as easily lost $1 billion, then making 100 million looks like it was just a flip of a coin. But if you make 100 million and the most you could have lost at the end of the year is 10 million, that's amazing. And these traders had the right biology, but the management knew how to manage them through risk management and through compensation schemes to harness that biology in a way that caused the traders to maximize their prudence. And that's really interesting. Now, and that raises the possibility that it is possible to build a better trader, to actually beat the broad market. Now I want to go in for the to show that a big determinant of the performance is in fact biological. And one of the things we did was we were looking at the effect of uncertainty on the traders. It turns out that our physiology is exquisitely sensitive to information, because information is the same thing as uncertainty. And you can gauge that in the financial markets by looking at the volatility of the market. And the stress hormones in your body are the ones that are most sensitive to conditions of uncertainty. And what we found when we looked at the implied volatility of the German bond market, which is what all these traders were trading in this study, we plotted, the bottom one is implied volatility of the German bond market, and the top one are cortisol levels, which is the main stress hormone. It's produced by the adrenal glands that sit on top of the kidneys. And they followed it. The top line is the cortisol levels across the trading floor. And as you can see, it's just an off-the-charts R squared of 0.86, showing that the state of their arousal was following the state of uncertainty in the market almost tick for tick. And this, by the way, replicates. We replicated this in a different study. Now, two interesting points that come out of this. First of all, is this important? I mean, if it turned out that their palms were sweaty when volatility went up, maybe it's interesting, but it's not important. To understand whether this is important or not, we took this hormone profile. So look at their stress hormones. They went up approximately 68% over a 2-week period. Now, to know whether that's important or not, we went back to Addenbrooke's Hospital, which is the research hospital in Cambridge, and my hotshot endocrinologist colleagues replicated this hormone profile exactly in a group of 36 volunteers, and then we gave them, under placebo conditions and under the hydrocortisone treatment, a state-of-the-art risk-taking task from which we could extract the utility curves and the probability weighting functions underlying the risk preferences. Now bear in mind, according to economics and finance, risk preferences don't shift. But when we gave these volunteers this identical hormone profile, this cortisol profile, the risk preferences collapsed 44%. This is a graphical representation of the expected returns and the variances of the lotteries they chose. Acute stress has no effect on our risk-taking because we love acute stress. Short-lived stressors are enjoyable. We pay to go on roller coaster rides. We pay to go on horror movies. We love trading the markets. We love extreme sports. Short-term risk, we love. We're built to support short-term risk-taking. Chronic stress is another thing altogether. We are not built for chronic stress. And it turns out that these stress hormones cross the blood-brain barrier and affect the way we think. And when we're in conditions of chronic uncertainty, our cortisol levels, this signal from our body tells us, you don't know what's going on, scale back your risk. And this shows the scale of that shift. So this is a 44% increase in risk aversion for what is really just a moderate, borderline chronic, and only a moderate increase in stress hormones. We think that during the credit crisis, when the VIX went from 10% to 80%, these cortisol levels went through the roof, And the financial community became so risk averse that they just wouldn't touch any risk asset no matter what the price, which is why the state had to step in and buy them for them. So to conclude, if you want to understand the pathologies and risk-taking in the financial world, you have to look at the fact that body and brain are twined. The really big moves in risk preferences are coming from your body. They're not coming from information or anything psychological. The other thing I'll say is that these traders were completely unaware that this process was taking place. And that's where this basically medical research sort of starts wedding with the digital future. Because the traders themselves and the risk managers were unaware that this process is taking place. You need an outside observer to view it. And you can get that through the monitors that you can wear. There's very clean ones like heart rate monitors. You can get it from more invasive things like saliva or serum. But you can also get it from a really well-informed outside observer, like a trading manager, a risk manager. You know what? Even your wife will do, or your husband. I know my wife is just incredibly good at spotting when I've got the right trade on, because I still trade. And she just watches my body language, and she can tell when I'm going to get it right, when I'm going to get it wrong. So I think increasingly, in the digital future of risk management, you're going to find that the tools of the digital future have to be wedded to medical science in a way that is not being done right now, but it's what we're doing. So I'll stop on that note. Thank you.
So what does this mean, John, for those who are trying to regulate markets? You now have to be an accredited investor to join an angel list syndicate. Do you think there is a case for arguing that you need to be a hormonally accredited investor?
No, because all the changes we're looking for are within subjects. They're not between subjects. So we're not so far looking at the fact that, you know, you're made for it and I'm not. We're just looking at changes within you that allow you to tell, I'm in the zone now and I'm not in the zone, you know, at another time. So we're not really looking at it as a screening tool right now for hiring.
But if you're a bank that wants to stop the rogue trader, I guess, taking that billion-dollar risk, is it in your interests to start measuring your trading floor for hormones, or is that?
I mean, they would have. There are cleaner ways of doing it. I mean, the main use of the sort of the medical science that we're doing here at Addenbrooke's is to have a better understanding where the pathologies and risk-taking are coming from, so we can inform the risk management search engines what to look for. In terms of self-monitoring, there are much cleaner ways of doing it. So we spend a lot of time looking for cleaner ways of getting the same information from, say, heart rate monitors or accelerometers.
What's your next research going to be on?
We've got about 8 papers in the pipeline. It's, you know, basically all different physiological systems of the body, and I think we're starting to get a pretty complete picture of how the all the pieces of the puzzle fit together to produce what is, you know, occasional rogue traders aside, we're extremely good risk takers. And I should point out that a lot of the traders that we're studying occupy high frequency space, which means they're locking horns with the algos on a daily basis, and they're holding their own, which is just unbelievably impressive. I mean, the machines came that close to wiping us out, and these, you know, we're fighting back.
This is the man I want programming my Fitbit. Thank you, John Coates.